firstly on this pair, the US dollar MX, Mexican peso. I think that's pesos. I think MXN, US dollar MXN. And first of all, before you get angry, why I chose exotics and not the typical Euro US dollar and the other more liquid pairs. The reason is that if you go through a lot of Anton Creel's work, especially on YouTube, he talks a lot about how at the retail level, a lot of traders focus on liquid pairs and not volatility. And that's just really, really important because what tends to happen is if you focus on liquid pairs, so the traditional Euro US dollar, US dollar CAD, Euro yen. The problem with those pairs is not necessarily that they're bad and you can't trade them profitably, but what tends to happen is because they have no volatility in them, you see a lot of retail traders over leveraging. So they'll over leverage to make more money. Whereas what makes money isn't the pair and the size, it's volatility. So essentially, you're asking, what is that? Volatility is this big swings. Think of it like big swings in the market. So this huge movement here, up, down, all the way down there. So big swings like this, and then up. It just means big swings in simplified terms. And because of those big swings, you can time in your trades properly, either you're trend trading or you're cycle trading. So that's why that's why volatility is really important, and that's why he emphasized it. So when you trade pairs like the traditional pairs, they're liquid, and there's a reason why the brokers make them cheaper. They're liquid because they're the most popular and they're traded often. So obviously it doesn't cost them a lot of money. But the exotic pairs cost a lot more in spreads because they're not traded as much, but they have volatility. And obviously, if you want to avoid the 90% of the retail traders, you have to do things differently. And that's the first thing that Anton talks about. It's that retail level traders are looking at liquidity and not volatility. That's really, really important. So I created my own volatility chart of the pairs I focus on, and then you update it every 6 or 8 months, and that's because volatile pairs change ever so often. So you have to constantly be changing your charts as well. So that's number two. So you'll find that as your account grows bigger, instead of like you'll find that as it grows bigger, you'll find it harder to make more money. So you'll end up trading 5 lot sizes, 10 lot sizes just to make more money, and it's because of the lack of volatility, right? So usually price will move up to one place and then come back down to the exact same place in the next 3 days. So realistically, there's no actual volatility in the market. So that's just really, really important. He talks about that a lot, and he says that's the main reason why a lot of retail traders blow their accounts is because they're trying to create volatility which isn't existing. Anyways, off of that. Second thing is traditional pairs, traditional patterns. Um, the issue I have with support and resistance, and I'll get into it another time, is that's the second thing again. Everyone's doing the exact same thing, and that's why everyone's getting the exact same results. You can't all be trading support and resistance and then wonder why 90% of them are failing. And even if you try to look at the markets a little bit differently and you look at patterns, for example, this is a rising wedge, right? So essentially, the philosophy behind a rising wedge is that there's first a downtrend, which is this one here, and then what the rising wedge is merely consolidation of the market, which is basically market is taking a bit of a break. And after that, we expect to see more downward movement or continuation. It's a continuation pattern where we want to see the same movement we've seen prior. So this was the prior downtrend, and then we saw some consolidation within this area, and then price started to push down. And obviously, as you can see, it won't go down within a day or within a few days. Sometimes it can take weeks, 3 weeks, 4 weeks, a month. And so it doesn't really help you if you place like five lots or you increase your position size just to take your profit here or down here. You have to wait for the whole move, and it also prevents you from over trading. That's also good. So this is a traditional pattern. Like I said, this is the consolidation, right? This is the consolidation. But getting the entry is also a second issue. right? And a lot of retail traders will obviously say, "Oh, it's stop hunting, it's stop hunting." But if you read, I forgot whose book it was. He said support and resistance is like cows running towards a fence. And what tends to happen is that the fence will catch the cows, but then the cows, their heads breach the fence, and that's pretty much what you'll see. So it's true that support and resistance does work to some extent, but your entries will be very tough because price does take some time to respond to demand. So, for example, if we're currently in an uptrend here, uptrend, 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 and then you plan on selling in this area here, price will go down, but it just won't go down immediately. It won't, even if you say, oh, well, support and resistance is an area. How do you know when to enter then if it's an area, right? So here's what you do. I prefer to wait for the breach. So this was the first touch, second touch. Sometimes it will touch this resistance area of the rising wedge and then just start to go down. But sometimes it won't. It continues to breach. So what you do is you wait for divergence. So this was a sell divergence. So I'd got in here on the sell divergence, and this is the 8 moving average on the 1 hour, because you can use the strategy on the 1 hour. It's a nice 8 moving average strategy on the 1 hour. I've seen a lot of people use it. I just don't use it so often, but it's really a good strategy. So anyways, this is divergence, right? It was offset by the divergence, and then that was the entry, and then obviously the stop loss was up here, and then we got in, held, 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 and then we saw a huge reversal around about the 6th to the 7th of July. I'm not sure why, right? And then we spiked up, and then this is when the panic happens. Then everyone starts to close their trade for some odd reason. And right now we're just ranging. So what I plan to do this week is I'm hoping that this is gonna happen, that we're gonna just see another continuation. Um, right? So this is a consolidation. In my opinion, this was the downtrend, right? And then the consolidation is this area here, this area here, this area here. So now what I'm waiting for is a touch to this area, possibly a bit of a breach. I like to wait for a breach first, and then once I've seen the breach, and then that's when I'm looking for an entry. But that's pretty much what I'm waiting for this week. I'm waiting to breach this bit a bit, and then that's when I'm entering. I don't know if there's a specific name for this pattern, right? I don't know if there's a specific name for it, but it does look like a rising wedge, which has a mirrored rising wedge. So say you placed a mirror along this, sorry, so it looks like a mirrored rising wedge. Say you placed a mirror at this point and you wanted to project this side onto this side. It would merely be a rising wedge. So it would merely be a projection of this larger pattern we've just started off with. This one here is essentially a mirrored version of this side here. So yeah, I'm waiting for this, the touch at this point, possibly a breach, and then I'm gonna enter another position, and then this will be the take profit there, and then this is the stop loss for this position here. So don't get confused with that, but this is the second entry to take profit here, and then obviously if it keeps going down, that's fine because this is the main position. This is just the scaling in position that I'm talking about for this week. This one here is a scaling in position. This is the original and still the target. I don't know if there's anything else I've left out, but pretty much those are the three things. Firstly, the issue of liquidity and volatility. Secondly, that the patterns won't be perfect. They never are as perfect as they look in the books. They always look very different, and they're not going to look perfect. Thirdly, this is a divergence, so you'll find that you have to implement a lot of things before you actually decide to enter a position, which just means that you need to have many confluences before you enter. And what that means is basically if you see something, it doesn't mean you automatically enter because we've hit support and resistance. It just means that you need many factors to consider before you jump in. So, for example, I considered the downtrend, and then I considered the pattern, and then the divergence, and then it seemed like a good entry. And then here I considered this downtrend, and then a bit of a push downwards, a pull back up, and then that's the confluence to enter again. Um, is there anything else? Patterns. I've seen that also, like now with COVID, though, patterns are getting a bit tricky. They're not coming out as perfect as they usually would, and I'm not too sure why. But it just seems that patterns aren't as neat as they would have been before COVID. And yeah, this is an exotic, so sometimes um, the pair will take longer than it's supposed to. So usually a rising wedge would just pull back, come down here, pull back, come down here, pull back, come down here, and it's usually done within a week. But this one's taking longer than usual, which is probably caused by COVID. I don't know if there's any other reason.